Hello and welcome to this episode. Today, I'm really excited. I am here joined with Fred Campbell, who is the founder and CEO of Trac VC. If I'm not mistaken, you guys have around $100 million under management right now. The really unique thing about Fred is he's not just an investor. He's not just a VC who's looking and investing in companies. He really takes the founder-forward approach. He himself has built 9 companies, 5 of which were VC-backed. One of them took to an IPO. So to say that there's a lot to learn from this man, I think is an understatement. So today we're going to be diving into a lot of the intricacies of his backstory, what it took to build those previous companies, how he's such a professional capital raiser, as well as what he would recommend you all do for your startup if you're looking to build, generate more traction, and of course, raise some money. So, Fred, welcome. It's great to see you again.
Appreciate it. Yeah, thanks for that intro. I hope I live up to it. So.
I think it's going to be a breeze for you. So I think where I'd really like to start is, I want to understand a little bit of your come up per se. I think what's really interesting about you, like typically some of the VCs that I meet, like they're just investors. They come up only investors, or maybe they had one hit. They had one company where they made a little bit of money and they were like, now I'm going to start investing full time. Okay. So would you mind kind of giving me like the quick rundown of where you came from, what those companies were, and we'll kind of just dive into that as you bring them up?
Sure. I hope I don't mess up your nice intro there, because I don't think of myself as a VC. I don't think of myself as an investor. I think of myself as a founder who's building a predictive software company. And it just so happens our business model is one of VC. So we don't try to sell our software like most software companies. We use it to identify future unicorns, and then we invest in those companies just like a VC. But I find it difficult to think of myself in the same camp as VCs. I have classmates who are very, very successful VCs at some of the bigger VC firms, and they're brilliant. I'm just not one of them. I'm a humble founder of a startup company, and I've had a few of them. So that right off the bat just sort of makes me a bit different from most every VC on the planet.
Yeah, and I guess just to dive into that a little bit more specifically, I didn't even mention this in the intro there, Fred, but for anyone listening, the thing that's really unique about Trac VC is they are a quant fund per se, right? So you hear about this way more commonly in like the hedge fund space. Like everyone's trying to get a quant. They're trying to build an algorithm that's going to beat the market, be able to trade using AI. So you guys are cutting edge. You developed this software for yourselves, and you're like, why would we sell this when it actually just works? That's basically right. What it sounds like to me. So maybe let's dive into your past a little bit prior to Trac, prior to this, software that you're working on right now. You mentioned you've founded 9 companies, 5 of which were VC backed, which is pretty phenomenal. So why don't we talk specifically about the 5 that were VC backed? What did you do? What industries? And yeah, let's go to there.
Well, they all have been technology companies, starting in 1992 when I founded eGreetings, which was one of the early .coms. And that company was very successful, became a top 20 website at 22, I think it was, on the planet, and went IPO in 1999, and did quite well, and it was a lot of fun. And then I took a couple of years and just traveled the world. I'm not a public CEO, so I went and found my replacement before leaving eGreetings in 1999. The company went public in fourth quarter of that year. And then I came back, and mobile was now the hot thing. So I started a mobile company called Lexi. And Lexi also was on fire, but it was raising a Series C, ABC, in 2007 when we had the Great Recession. And I couldn't raise a Series C, and the company was basically bought for, not very much money. And that was a great lesson, though, because every founder needs to pivot and continue to pivot quite frankly, until they're never going to stop pivoting, quite frankly. And I did not pivot fast enough from a BlackBerry to the iPhone. And if I had pivoted, that company would be probably still in business. It was the first blogging site on the planet.
Wow.
Audio blogging site, excuse me. And then started a company called Mobile Broadcast Network. All these are VC backed. And Mobile Broadcast Network was a disaster. It was probably one of the best pieces of collaborative mobile video technology on the planet for media professionals. And I could sign up major media companies to use the product because they loved it. It was, a video 10 times as fast for 10% of the cost of traditional video, but it was way too early for the market for the people on the street. Like Sports Illustrated wanted to use it for the Olympics in London, but the people who are writing, blogging, the writers are for Sports Illustrated, didn't like holding a phone in front of them and talking and making a video that way. It was beyond their capabilities. So that was actually the reason why where I am today, that loss. I ended up selling that to the NBA, the basketball league, and they still haven't done crap with it. But I left that thinking, okay, that was a boneheaded thing for an entrepreneur to do. Is there technology that helped me as an entrepreneur better predict market timing, product market fit, market size? Who are the competitors in the space? And there just isn't anything like that out there. You have to do the research yourself. And it's often expensive and more expensive than founders usually have the budget to go out and buy all this data. And most of it's not available for free. So I started Trac, started CrowdSmart, the fourth VC-backed company, to solve that problem initially for myself. And then I realized, well, hell, every founder has this problem and every investor has the same problem, right?
Yeah.
So CrowdSmart turned out to be incredibly predictive. We could take a business idea from a founder and/or university. UCLA was one of our biggest clients initially. And we, with 85% accuracy, could predict that idea not only could raise a Series C, as in seed, CEED, but also a Series A. And most seed-funded companies cannot make it to a Series A. Only about 20% make it. So going from a pre-seed to a Series A, it's about a 1 in 20 chance, about a 5% odds of making that path. And we could do it with 85% accuracy. So it was incredibly accurate. But it wasn't scalable technology. So then I started Trac. So to solve that problem, CrowdSmart's still going strong. It's a prediction to the service business for big media and big companies like Intel and Microsoft and whatnot. And anybody on this who wants a great prediction for about $50,000, go to that company. And then Trac was built on that technology, that AI technology. Partner at CrowdSmart was Dr. Keller, who was the chief scientist and CEO of the first AI company to go public in the United States called IntelliCorp. Brilliant dude. And anyway, I built on that technology. So Trac now is the fifth VC-backed company. We've raised seed in the Series A. We're going to raise a Series B this year for Trac, the technology company. And it's working. And with Trac, I can pretty much track every company on the planet. If you have a pulse, if you have any web traffic, any social media, anything, it's in our database. And we can then start analyzing the market signals for you and all your competitors.
Yeah, a lot to unpack there. I think that's pretty phenomenal, to say the least. I think what you actually hit on, like, a lot of founders don't necessarily take into account how important timing is for their idea, right? Even if the idea is great, like, it sounds to me, you are always really ahead of the curve. Like, that's the trend for Fred. that is the trend for you, right? You hit it on the head with e-greetings, and then it sounds like, Mobile Broadcast Network, you were just a little too early. Lexi, maybe a little bit too early. And then, of course, who can expect a massive recession like that, right? Like, so it's difficult when, like, just the actual timing of things just is what makes your business be interrupted. And I think that that's really interesting that you now are kind of like using AI to help predict when that right timing is. I feel like more and more companies are going to be trying to do that. So just to make sure I'm understanding correctly, you've got Trac, the actual software company. So you're raising funds for that actively. You said you're going into a Series A?
B this year.
B.
Yeah, we raised the Series A last year, and
Understood.
at about a $55 million valuation, and we'll raise this year in about the $100 million range. We'll see. The market's soft, we'll see if we can get to 100 million, but I think we can.
Yeah, so I guess one of the questions that I have for you that I'm really curious about. So I know you've raised a lot of, I would say that you're probably one of the best capital raisers that I've ever had, the privilege of speaking with. How much money have you raised as a founder for actual startup capital? Not LP capital, right? For the fund Trac,
right?
But actual startup capital. How much do you think you've raised in total? I'm curious.
$250 million. Most of that was a very late stage for eGreetings.
Mm.
We raised a large bridge. I think it was about $200 million before we went public. So probably $50 million for more what typically your listener will be, from seed A and B, and that's probably about a $50 million range.
Yeah, that's crazy.
And that's every company that I mentioned has raised at least 2 rounds, so that's 10 seeded A.
Yeah,
and somewhere between 12 to 15 rounds for those different companies before they get into the big dollar amounts in the IPO. But honestly, for that, and each probably had, let's say, an average of 20 investors. And then if I close, back then I used to consider a 5% close rate. So I pitch, 100 investors and I get 5 to write a check. I was pitching most of my life. I feel like I've spent half my life raising money, which is one of the reasons why I wanted to start Trac, because I think it's a complete waste of time for the most part to raise. It's a necessary evil. You got to do it, right? You got to have money. But most of the time I was pitching investors who were just interested in the idea, but they're zero chance they're going to invest in my company. And so I wanted a more targeted way to find the people I should be pitching to. And that's part of what Trac does.
Yeah, I've seen some of that technology. I believe that you shared with me in terms of like finding the right investors. And I think it's fascinating. You said a stat to me one time about total amount of venture investors are like 250,000, right?
Right.
How many of those actually do you believe will invest in any given company? And just dig into that a little bit, because I don't think people understand, even if you're talking to an investor, what you said, it could just be because they're interested. They could just be collecting information for a portfolio company. They could just be talking to you for fun. So what percentage or what number of investors do you think are even eligible to fund a company at any given time?
There's probably no science behind this, but I will say there's science behind it, but it's going to be hard for your listeners to believe this one. But there's about 250,000, you mentioned, investors in technology, early through, let's say, B range. There's a few more if you add the later stage. Maybe 0.1%. So 250 potential investors in your company. I mean, it really would write a check, right? So it's a needle in a haystack. It really is. And that's why it's so frustrating. If you go take a YC company, the last demo day, there was like 45,000 people on the call, right? And with the exception of a few companies that would raise money like right now, and they had hundreds of people participating, I would probably say, maybe 10 to 20 investors contacted each company in that range. So you're talking about a really small percentage of investors who are, and these people are really on watching YC to invest in YC companies, right? And yet the vast majority of YC companies have or get a handful of investors, right? Very few of the companies we talk to at a YC have like more money than they can possibly, handle. And so they tell you to go away. But so it's hard, right, to find the right investor.
Yeah. And I think like what you said, I'll tell you this, like we talk to a lot of startup founders. Like we talk to anywhere from 300 to 400 startup founders per month, like at least. Okay. So one thing that I think is greatly underestimated is the amount of time and the opportunity cost of raising money constantly. Because it's not like you're going to raise money and then, all things are solved. It's you raise money, you get just enough time to go back to building the product, the team, generating some traction, and then you're like, oh, well, the account's going down. We got to start thinking about that next fundraise, right?
Right.
And it's a constant battle. And like you said, it's a waste of time because like where time's best spent, which I'm curious in your thought, I think it's obviously getting product market fit, right? Like generating more traction so that the fundraise is easier and easier. And like you're trying to lower the barrier of the next fundraise. Like that's how I try and look at it. Anytime you raise money, you should spend that money to make sure that the next time you raise money, it's as easy as possible. Okay. So
Right.
How do you feel about that? Do you think that that's a pretty fair philosophy?
No, it's absolutely fair. I mean, look at it's a luxury for a founder to have 18 months runway. 24 months would be just, that's what you want to shoot for, a couple of years, right? So then you can start fundraising when you're, hopefully have a year of capital to bank, and then make sure you close before you have 6 months. So if you think about that, you've got, if you're really lucky and you get a couple of years of runway, you've got 1 year to work on your product before you have to start fundraising again. And if you have 18 months, it's down to 6 months. So it's constantly coming at you, which is, by the way, that's a high-class problem. That means you're growing, you've got something. But to your point, my experience of fundraising, the reason why I can now raise money for my companies is I spend my time focusing on getting the signals in the marketplace so the investors can find me rather than me find them. So, and it partly is, yes, I've got a track record and that sort of thing, but it started with e-greetings, right? I was out pounding the pavement and I happened to get lucky. My business partner came out of Leo Burnett, which is a big advertising agency. And he was really good at getting us media attention. And as soon as we showed up on the business section of the Chronicle, San Francisco magazine or newspaper, I never had to call a VC again, never had to call investors. They were calling me, right? So it changed the dynamic. So, I mean, this is not a paid plug for your firm. And you didn't even ask me to say this, but what you do is get some type of signal in the marketplace for your clients. And that is, VCs will tell you, don't bother doing this, right? No, that's just crap. You want them competing. And by the way, that's how VCs find you, right? They'll get the warm introductions. Cold calls almost never work. But if you get a warm introduction, you'll take that. The VC will take that call. But what they're looking for is breakout in similar web. They're looking for web traffic that's going up. They're reading the media. They're watching social media. They're seeing who's got the buzz, right? They're looking for, increase in headcount within LinkedIn or other services. So they're looking for market signals, right?
You're exactly right.
That's how they find companies.
Well, I'm curious on your thoughts on this. So our philosophy is obviously PR is very important, but like there's 3 pillars that we basically say like help with a fundraise. Okay. We call it narrative. So whether it's narrative directly from publications or narrative of like social media being talked about, going viral on some posts, it's also just like how well can you articulate even what it is that you're building, right? If you don't actually know what you're talking about or if you can't explain it to, we call it like a 6th grader test, then you're going to be in some trouble because you need to make sure you can communicate. The second thing is, of course, traction. Like there's nothing, even if it's a great story, if you have absolutely nothing to show for in the market, like zero customers, zero demand, then you're kind of out of luck. And then the third thing, of course, is investor meetings. And I think that the investor meetings thing, like to your point, it becomes so much easier when you have the other two. Like if you have like a compelling narrative, if you have a compelling story going around yourselves, if you have traction, it almost makes it so that your fundraise will fill itself. I mean, right now in this market, I think it's going to be difficult no matter what. But to your point, to what happened with e-greetings, right? You didn't have to go out and chase. You created this frenzy, almost like a bidding war amongst investors. And I think that is what the real dream of any startup founder is to have people that reach out to them to try and fund their company. You know what I mean?
Yeah, so you get that first one you mentioned, the narrative, right? You've got to have a great story, and you got to be able to tell that story in an elevator. I mean, and if you start off with, watch the Golden Circle on YouTube, but you got to make sure you tell the story as to why you exist and make it compelling really fast, right? There are investors out there. They're pre-seed investors, and every founder is going to have a place where they have an idea before they have product market fit. That's just the way it happens, right? I mean, unless you're an engineer, or unless you're the person who's building the product, whatever that product may be, you probably are going to need some resources before you have any real market traction, right? And fortunately, the good news here is if you've got a great story, if you've got a compelling story, you can raise money. You don't actually need the second pillar. Now, it will absolutely help if you have that second pillar, right? So, when we invested it in LifeAt, they hadn't raised a dime yet, and they were already in the top 20,000 websites on the planet with a couple million people using their product. A couple of guys just built this product and just took off, right? So that's pretty simple. If you've got that, guess what? Most VCs don't really know. I mean, I had Mike Moritz at Sequoia one time. I was pitching him, I think it was Lexi, and he said, I have no idea this is going to work or not. Really don't have any idea. But he showed me a graph of YouTube. He said, you walk in with this one graph that shows this kind of traffic, I'll give you all the money you want, right? So to your point, it's so much easier to raise if you've got, serious traction, market traction, whatever your product is. But, hey, we invested in Stoke Space Technology. They're building a completely reusable rocket like SpaceX, but both stages reusable. Guess what? They had no product market fit.
Okay.
And not likely to have any product market fit until they raise about $200 million, right?
Yeah. So I think that brings me to, one of the things that's really interesting about what you're doing at Trac, the fund, is it's like, if I'm remembering correctly, again, you don't actually really hear pitches. You simply have someone fill out a form. You have like some sort of like a submission process, and then the algorithm decides. So there's no human, which is very, very anti-VC, right? Which I love, because it's all about like humans and like there's a lot of like that, those components, right? The human component. So I'm really curious, like what within Trac, like for just so maybe any startup that's listening, like what within Trac's algorithm can people try and like be more like? You know what I mean? If I'm like, man, I want to get funded by Trac, how do I design my startup to get picked up by the signals that the algorithm says is going to be a unicorn? Like, could you just elaborate a little bit on like how that how that works?
So a little caveat first. What you said is absolutely true, except we also use human discretion to say, yes, you pass. We're still not going to invest in you if you're doing something that we think is not good for humanity, right? So,
okay,
one of some of the vaping businesses passed our algorithms, but we said no. The world doesn't need another vaping, whatever. So with the vast majority of founders want to do something positive in the world, so they would meet. Yeah. They don't get that restriction. But you're right. I want to make it incredibly simple very, very efficient to get the capital and predictive data you need to succeed. That was my goal as a founder. For myself, that's what I wanted. And then I wanted to give that to other founders. So the good and the bad of Trac is I can tell you in about 10 minutes if you qualify for capital or not. And the bad news for Trac is that I don't care how good your pitch is, I can't invest in your company. So the signals we look for, they're sort of universal signals. They're based upon this idea that everything in existence emits information. Even a black hole emits information. So you can't look inside a black hole, but you can still measure it's where it is, how big it is it sucking up everything around it, or is it going to get sucked up by something bigger, right? So we're looking for essentially your position, momentum, and your attraction. So are you attracting the right resources? Is that attraction creating some momentum? And are you positioned in an area that's likely to grow? So for example, one of the signals that's hardest for a founder to control, you can control a fair number of these signals, but if you pick an area to compete in, and founders are often, especially first-time founders, I think they're ill-advised when they say, when they tell an investor there's no competitors. It's going to be really hard to become a big company if you're all by yourself. You need competitors. You want competitors. You want competitors who are killing it in the marketplace. And then, so that's the first signal we look for is your business in an area that's expanding rapidly? And guess what? Almost universally, unicorns, the big successful companies, forget unicorns, but successful companies, market leaders, come in an area with a rapid expansion of a whole bunch of competitors in that market space. That basically means there's a lot of demand from the end consumer. That's a need that's got the right timing. So the whole product market fit and the timing, that gets answered when you look at the larger community, right? So we do that programmatically.
I'm sorry to interrupt. So kind of like AI right now. So how like there's like all of these like language models like Jasper or whatever. Like there's like 20 companies that do that now, similar. Right. So like that is kind of what you're talking about. It's like, is there someone else that's doing it? Obviously there's differentiators between each company, competitive advantages and so forth, and that's what makes them unique. But you're saying when there's other people doing it already, that is a good validation of market. You don't want to necessarily be on the first wave. You want to be.
It's okay to be on the first wave. I mean, but you don't want to be so far ahead of the curve. So when I started Mobile Broadcast Network, there was Vine hadn't even been around. That was the Twitter thing, right? So I was just too freaking early. People were not comfortable yet talking to their phone, looking at their phone, doing video blogging. That idea 5 years later would have been a killer idea, and the technology would have been superior to some of my competitors, and I would be competing with, the TikToks of the world. So it was just market timing. It was just too freaking early. So if I'd had that technology and I'd looked at the market and I said, well, if this is such a big idea, why isn't anybody else doing it? Right? And if it's such a big idea, what are consumers or what are the end users doing as a substitute product? And if they're not doing anything yet, it's probably not it may be a great idea, but it's just not the right time, right? So we're looking for, we can take that company and analyze you very accurately. I would say that's probably the crown jewel of our technology, is that we can programmatically identify every one of your competitors in the world. And that's really hard to do, right?
I was going to say, how are you getting all of this data on private companies? I mean, obviously, don't tell me the secret sauce too much here, unless you want.
Anybody can do what we do. Seriously, anybody can do what we do. You can just spend $250,000 a year or more and buy some data and, hire some data scientists and then analyze the data. But no, so we buy data from public sources. We have a few private sources, a few VCs give us access to their information, a few accelerators, but for the most part, for the financial information, it's PitchBook, Crunchbase, Traction, whatever else. CB Insights, right?
Yeah.
And then for, media, we get it from Meltwater, Owler, SimilarWeb, so we're buying data from, 20 different sources. Anybody can buy the data, just, spend the money.
Yeah.
And then you got to, the hardest part, one of the hardest parts, you got to merge all those pieces. And guess what? There's probably a few Michael Hummels out there. So we have to figure out who you are and somebody else who has the same name, right? Even URLs are not, but I'm getting sidetracked. So a lot of data. And to answer your original question really fast is that we're looking for what are the quality of the resources you're pulling in. So what's the quality of your investors, employees, customers? We look at their media and the quality of the media too, right? So if your brother or your mother is promoting you, that's one thing. If somebody from Business Insider or Wall Street Journal is, that's another thing. So hire this guy to help you get that great media attention, and that's going to pay off. You're going to get ranked higher in our algorithms if people are talking about you, and if they're talking about your competitors, that also absolutely helps you, right? So, that all that information, basically, customers, competitors, investors, employees, media, and
that's so
any of those things you can control the employees. You can control to some extent your social media outreach, how much effort you put into it. You can control the quality of the investors. That's the biggest thing, guys. So if somebody wants to give you a check, treat it like you're going to get married to that person, right? You get to know them. You get to know the quality of their investments. If they have invested in a lot of companies that have failed, if only companies that have failed, they'll actually drag your score down. They'll make you less interesting to invest in because your people you're surrounding yourself with are not successful.
You want to take money from winners, that's for sure. I think.
Yeah, you want money from winners. You want employees who are winners, right?
You're totally right. Yeah. Well, I think that, that and it's in general is a really good roadmap for a founder in terms of what actually matters to investors, right? One, do you have competitors that basically validate the fact there is a market, there is a need? Because even if you have an idea, you don't need to be the one with the product market fit. You have to have competitors maybe that have the product market fit that you can ride that wave, and you have a good story around why you're going to be a good contender, right? So I think that's number one, right? Number two, what you take into account is resources. So are you getting the human capital in your company that's capable of building this, capable of making this come to reality, as well as are you getting the humans that are writing those initial checks? Are they people that have actually made the right bets before? Or are they does it matter if they're first-time investors or like angels or so forth? Or I guess, how do you take that into account? I'm curious.
Well, so from a predictive point of view, individuals are more predictive than firms. There's a lot of politics that goes into a VC firm when they make an investment. So I'll invest in your deal, or I'll back your deal if you back mine, kind of thing. Yeah. So individuals for example, there are about 300 super forecasters. That's the top 10th of 1% of most accurate investors in the world. And 80% of them are individuals, not firms. So
that's crazy. I didn't know that. Okay. So first competitors, second resources, and then third was media, right? So having either a lot of traffic, so driving real traffic to a site, going viral on social media, getting coverage, just getting talked about, it sounds like, so that it's showing that the market's responding per se to what it is that they're working on.
You know what? There's so many places, right? I mean, there are so many places right now you can go to, whether or not it's open source environments, if you're using some open source in your product, or, some of the sites where, you can manage your code base. There's some obviously very big companies in that space, and others in the community can rate you, right? So VCs care a lot about what other experts are saying. They're not experts for the most part in what you're doing. So they're looking for signals from others who are experts to see if you've got something that's really unique. And so, it doesn't have to be traditional media. You don't have to get a Wall Street Journal or Business Insider or, information to write about you, but that helps. But if you can get your peers to write about you, I mean, even a LinkedIn post, if you can go out to people in the community within LinkedIn and say, hey, you are really hot in this environment. Would you like mine and share it with your community? Those are signals. Those are really good market signals that you've got something unique that people are paying attention to.
Well, what I would sum all of that down to, what we say all the time is, like, it's kind of a blunt way of putting it, but it doesn't matter what founders say. Like, the founder can talk the talk all they want. However, every mother's going to love their child,
right,
no matter how, how that child actually is. And I think that's like the issue. Some people are like, well, don't you see it's such a great idea? And it's like, well, is anyone else saying it's a great idea? I think that's the thing that you're getting at, is have someone else who has a little bit more weight, a little bit more credibility, like, not saying the founder doesn't, but just anyone else validating the claims that they're making. And that's a positive signal for investors. That's what I'm
Yeah, it is. And I would say that it's the echo effect of that's actually the most powerful, because it sends a signal that's not coming from you. Yeah, they're eventually going to call you, right? The VC or the investor, the angel, or whatever. They're going to eventually talk to you to say, I've heard about you, what do you, and so you've got to be able to tell a great story, right? Mm-hmm. The more you have traction, the shorter your presentation. It's just, like Moritz said to me, hold up a piece of paper that shows your adoption curve, right? Your customer traffic or your revenues or whatever it may be. And if it's a hockey stick, sign me up, right? If you don't have that, then you got to have a very compelling pitch. Please do not start with your technology. We're an AI company that, whatever, with this best and whatever. That's not interesting, right? What's the problem you're solving? And, anyway, we can go into that if you want to, but to have that story, and a guy like, Michael, you can I'm sure you help your clients tell a great story. That's part of what you guys probably do, but it takes
plugs here, Fred, all the plugs. I appreciate it.
Paying my dime, by the way.
I know. I'm like,
as a first-time founder, I probably would not have been, as knowledgeable about actually can move the needle. I got lucky with my first VC-backed companies when I had a media-focused co-founder. But at the conference you and I spoke at, my heart goes out to the founders who go to those things. And they should, right? It's good practice, right? But it's really, you walk around, you're meeting some random people. Jesus, what a freaking waste of time. I mean, again, not to say anything wrong against conference. You should probably do a few of them. It's so last century.
I think the issue with it, like what I suggest for founders is to use those as, like, one, obviously, as you said, some practice, right? So like, just get the rocks out of your mouth, okay? Like, get down what you're saying in front of people so you don't botch it when you're in the right room, right?
Right.
And more so, if you do happen to meet the right investor at those, you're not going to get a check. Like, by no means. Like, there are 1,000 people, if not more, at these conferences, right? And for you to think for a second that you should try and actually get into a deep conversation during that time with anyone, it's a giant mistake. You're simply there to meet and get them to like you so that you have another conversation when they're not getting bombarded. Because I told you when we were there, I was like, I don't envy you. Being an investor at these things, you're chased the whole time because the second they see your badge, right, that's when they'll be following you around, which is
fine, right? It really is fine.
I get it.
What you said is absolutely right. You need to practice and kind of immediately assess whether or not this investor is your A, which is you want money from this person or this company. Mm-hmm. B, be nice, but whatever. Or C, I don't want this person's money, right? But hey, so practice, try some new pitches on that one, right? But don't try the new pitches on the A group, right? So I see you got to practice. You got to be great at presenting. So when you do get in front of the A group, you're quick. You know how to get to the point quickly. Well, here's my value proposition. Here's a compelling story. And you got to be able to say that in literally less than a minute.
Yeah. And what you're saying there is like, I'm sorry, continue.
No, go ahead, please.
I was just going to say, like, what you were saying to recap is there are 3 different tiers of investors that you can kind of, per se, like, categorize that as. C investors, people who you're like, I'm not going to take your money, but I'll talk to you. And that's pure practice. B, you're like, maybe if we like go deeper and I find out more about you, it could be a good fit. I need money bad. And then A, those are I agree. There are like a very finite number of investors that are like your dream investor. And you don't want to waste your, bad pitches on those ones because, quite frankly, you don't get a second first impression, right?
Right.
And first impressions matter quite a lot, especially in VC, I think, because it's kind of how you hear everything afterwards. You're like, first time they were pretty bad. Like, what happened since then? You just always go back to that moment, I think.
I've got a really good friend who's a founder of a very cool company that I've been advising for a while. And I had one of my investors that I knew invested in his space. So he was an A group investor, great guy, spent a lot of money in the market that my friend's company's founded in. And I said, just go ahead and practice on everybody else. Leave him. And he just thought, okay, I'm ready. And it's like, okay, whatever, right? And he just couldn't he couldn't convince them that he could get big. He liked the idea, but he just wasn't seeing how okay, I like the idea of this. I'd want this for my kids. It was in the education space, but I don't see how it gets big. I don't see a roadmap. And so when my friend finally, he's got a great idea now. Now he's figured it out. And this is 6 months later. He's lost that investor. He's gone.
Perfect example. So I want to transition here because I value your time and I know we're going to be coming to an end here soon. But, one thing that I think is really interesting about you, Fred, is you're so early to trends. Like your previous companies, like that's what that shows. And I also think that you're early to this trend of AI in VC. So I want to talk a little bit about that and talk a little bit about just like the direction that you think VC is going because, I don't know. This is not a subject that I'm necessarily an expert on, and I would like your advice. So when I hear what you're doing, it sounds like very foreign. I feel like I actually know quite a few quants, but they all work at hedge funds, right? So that's always fascinated me, and I think it makes a lot of sense for hedge funds. Like people see like the market, like you can build algorithms, like it's very proven. However, you are the first person that I've ever met that has this in the VC space. So, I mean, I guess like, could you just tell me a little bit about like what you think, like, are you early to that? Like, are you an innovator there? Like, what do you think's holding other VCs back? Are there more than I think? Like, I know that's a pretty loaded question, but give me a little bit of an understanding of like what you see this turning into,
So I said 5 years ago when I saw how well CrowdSmart was working, and it was like, this is just amazing. You can improve your accuracy, substantially, in big orders of magnitude. I said, everybody will be doing this. Every VC investor will be doing this in 5 years. Guess what? No. So I'm making a new prediction. In 5 years, all the VCs are going to be doing this. What I've learned is that, I have an MBA from Stanford, and a number of my classmates are really successful VCs at some of the bigger VC firms. And they told me from day one, it's impossible to predict which startup will succeed. It's just impossible. It's a random walk, as I was told, right? And quite frankly, they don't really care. VCs don't really care. I mean, they would never tell you this, but they don't really care if you're going to go out of business because they expect the majority of their investments to go out of business,
right?
Because they invest for what they call the power law. So 1 out of every approximately 15 investments will return big money, like 100x if you're a seed investor, right? So hell, if that's going to cover all your losses and you're just looking for they're looking for the needle in a haystack to turn into big wins. So it was considered impossible. And what I've learned is that egos die hard, right? For the most part, I really do respect VCs. They're really smart people. They've convinced other smart people to give them, they basically, the story goes, they've convinced a bunch of strangers to give them money so they can invest in a bunch more strangers. That's the VC business. And so these people are really, really smart. They're good at what they do. They're usually the brightest in their classes. And so they play the odds business, and we took a different track.
It's like play on words. I like it.
That's one of the reasons why I picked that number. There's a lot of use cases for track, right? We're the track team, right? That sort of thing. So there's a saying: if you repeat the same thing and get the same outcome but expect a different outcome, that's insanity. The VCs have been doing the same due diligence for the last 50 years, and somehow they expect that the outcome is going to be different. And it isn't. About 20% of their seed funded. So last year, according to PitchBook, 3,200 businesses that had previously raised $27 billion went out of business.
Wow.
And it's usually in the $10 to $20 billion range every year of seed funded companies that never can raise another dime. Sorry. So they're throwing the money away every year. It's remarkable, but they do the same due diligence. So we said, wait a minute, maybe there's a different way to do diligence, and let's look at these market signals. And quite frankly, we didn't know if they were going to be predictive. We found out they're actually really predictive. In fact, I would say that a company's external metrics, including some of the things you mentioned, like product market fit, whatever, the demonstration of that, right, are more predictive than whatever the company's deck would tell you. Right, and internal metrics would tell you, right? Until you get to about Series C, and then, boy, you better have your cost of, customer acquisition, your lifetime value of a customer, and all that other stuff, right? That better be down pat, right?
Basically private equity at that point, quite frankly.
Right.
Once you get to that point, you have a track record. I think the issue, but basically, you're totally right. You go seeds, Series A, all of that is it's pretty much narrative driven, because it's like, how much hype, how much momentum can we build in such a short period of time that people think it's going to continue on? That's what it is. I don't
to your point. No, your point. I mean, that's what you're doing. And the more signals. So if you can say, hey, I've got this momentum, and you can show it, right? You're a Series A stage company, and you've got every other company that, hey, one of my competitors just raised $100 million, and it's only 6 months or a year older than me at a $1 billion valuation. And you can get in my company right now for, a $30 million valuation, and I have a shot at catching them because I have this unique little thing that they don't, right? That's a compelling story, right? You could tell that story really fast, right? Because you're pointing to other success points and you don't have to convince anybody that customers care. Because ultimately, that's going to be your success or not. Do customers actually, are they going to spend money on your product, right? And nobody knows that. Honestly, nobody knows that unless they're...
Totally do.
Right? Yeah. And customers, your competitors, can help you answer that question. So the big moral, the takeaway of this would be two things. Find your competitors who are hugely successful, and that's a good thing. And then spend time picking the very best investors, employees you possibly can that don't have your same last name. So
I like that don't have your same last name. That's funny. Fred, I'm curious, you're talking a lot about how well this predictive algorithm is. Do you mind speaking to your own results so far?
Sure.
Any insight that we can get? And I also think that if you want to touch on, after that, your success fundraising from LPs, because you're basically the greatest fundraiser that I've ever met now, from what you've told me. So, but yeah, just give me a little bit of insight into how good is this algorithm? I'm just curious.
Sure. Well, I'm going to do the same thing I just recommended. Use other people to judge me, right? There's a company called Preqin that's kind of the Nielsen rating for VC funds, right? They aggregate information from VC funds, and then they rate the funds relative to each other. So our first fund was a vintage 2020. So 2020, we launched the fund. It was an early stage fund. So they have early stage, they have growth stage, they have late stage, right? So we're an early stage 2020 VC fund. There's 751, according to Preqin, funds that meet those criteria. And we are, according to Preqin, we are 11th of the 721 firms.
Wow.
And so, is it working?
That's amazing.
It appears to be working, right? Yeah. According to
You're like, yes, it is working very well.
And
that's phenomenal.
Yeah. So it's our metrics are for where we are right now. You wouldn't expect any of those 2020 funds to have any sort of exits, right? They're too early to have exits. So what they look for is one of the key metrics is what percentage of your portfolio has had a follow-on funding, and is that follow-on funding been an up round, down round, or whatever, right? And so that's one of the key metrics. And the more up rounds you have, the more likely you're going to have winners in that camp. And for right now, for vintage fund 2020, the average follow-on rate is about 30%, which is pretty typical. That's been that same for the better VCs for a long time. And we're about 60%, so we're about double the average.
Wow.
The highest among all of the group is about 72. So that's really good. That correlates almost 1-for-1 for how the fund will eventually do, 5-10 more years from now, kind of thing. And we're actually better for Fund 2. We're actually number 2 out of 800 and something firms right now. It's really early for Fund 2, which is a 2022 vintage. So it's only been around for, on average, let's say 18 months. So it's really early.
And you have $100 million under management. Is that correct?
About that, yeah.
About that.
Yeah.
That's incredible.
We have 2 funds and about 7 SVPs, special purpose vehicles. And we plan to raise another 100 million latter part of this year.
Casually. Let's talk about your fundraising success. So this man right here can close. Like you said, he's been pitching his whole life, half his life. Tell me a little bit about your success rate, because I think that's phenomenal.
I would say if you do your job, a first-time founder, if you do your job and you really filter out investors well, you should at least be in the 5%. So pitch 100, you get 5 investors, right? That's sort of the worst case. That's where I was initially, right? When you get better at it and you tailor, you really don't pitch to people that are not likely to invest, right? You just save your energy. You should be able to get that number up, maybe 1 out of 3 or something, right? I mean, if you're first time. With Trac, and it really is not me. I have a business partner who is, I can raise money for software companies. That's my background. He raised money for hedge funds. He was a hedge fund-to-fund manager. So he knows how to talk to high net worth individuals. He leads the pitch. Then I come in and I'm the straight man and I do all the demo for our technology. For every 10 investors we pitch, we closed 8 investors. That was our close rate. So 80% close rate for our fund.
That's crazy.
So it was crazy. And I think partly,
and these are
to your point,
just to be abundantly clear.
Yeah, these are. Well, I wouldn't put in the VC business. The numbers are getting just nutty. I mean, $1 billion funds. Yeah. So our fund is small by comparison to most VCs, right? And Tiger Global or whatever, was just ungodly amount of money they raised. But so no, we're small potatoes in the VC business. But so our typical check for investors about $1 million for the funds from an investor. We only went after high net worth individuals. We didn't go after institutions. They don't invest in first time or even second time funds. But again, most of your listeners are probably on the startup side. And but if you do have some aspiring VCs out there, then raising money from, here's how we did it. So when we raised our first fund, we decided to pair the technology company, the GP, which owns the technology, with the fund. So we said, we are going to give you the opportunity to invest in the VC firm, the general partner, the technology firm. And for every dollar you put in that, you have to put in $10 in the fund. So that's how we did it, right? And we had a very compelling story for the technology company, right? It's a really simple story. I mean, I don't really have time to tell this simple story, but basically the simple story is my technology can identify what we call the super forecasters, the top 1/10 of 1% of seed that first investor, that first check you get, right? There's a lot of people, hundreds of thousands of people that will invest in the early stage, and there's about 300 that are incredibly super predictive, right? And we know who they are. So if they invest, we come in right behind them, right? So it's kind of a Warren Buffett story. It's like, hey, we know Warren Buffett's, every one of Warren Buffett's trades, you can follow those trades. If that was true, you would make a lot more money, right? So we've identified the very, very best investors in the world. So we said it's really simple. We just identify the best investors in the world and we get in those companies. And then the question is, well, how do you get in those companies? Those companies are probably really hot, and they are, by the way. If you can attract one of these people, it means you've attracted a lot of interest. So we said, well, we have this technology that will give them predictive information they can't get from any place. They can identify every one of their competitors. They can identify every great investor that should be in their company. We can price their rail for them programmatically and be really accurate, right? So we're kind of the Switzerland for a founder to have on their cap table. We're just data providers, right? And so every founder I pet, if I call, I don't get incoming. We just call who we want to be involved in. If I can get a founder on the phone, I have not been turned down since November of 2021. So I'm basically 50 out of 50 because I'm providing something that they cannot get from any other VCs. No other VC on the planet provides them, and they can't buy. I mean, you could buy if you wanted to spend a lot of money, but hell, with my data, I save you about $250,000 in data cost. You don't have to buy a PitchBook, CB Insight, Fundraise, Traction, SimilarWare, whatever. You can just get that data from me, right? My license only allows me to give that to my portfolio company, so I can't give it to anybody else. But
right.
So yeah, you get all that for free if you just put me in your cap table. So it's a pretty simple value proposition.
Yeah, that's amazing. Well, I guess as we wrap up here, why don't we end on right now is a very strange time in venture capital. I want to say thank you so much for your time. First off, this has been really exciting. It's a strange time in venture capital to say the least, right? There's a ton of dry powder per se out there, yet no one's really investing. Like everything's just kind of going down, right? Everyone's holding on, hoping interest rates come down, hoping that we figure out what's going on. It's an election year. There's a lot going on, to say the least. I am curious on if you have any predictions for what's to come, as well as any recommendations for founders that are listening in terms of what they should do in 2024 to, if they need to raise money. Should they just give up and turn away? Or do they, what is it that you would actually recommend to give them the best go at raising a round in 2024?
So as I mentioned a few minutes ago, I'm really not a great predictor. I've discovered I'm kind of an average predictor, and most people are. So we actually look at super forecasters. They are actually incredibly good at predicting the future, including how the economy is going to go. So, for example, super forecasters stopped investing in 2006 before the Great Recession. And then they started investing again pretty heavily in 2008 before the end of the recession. And that was actually 2028. It's one of the best years for, if 2008 was just a portfolio, that would be about 200 times invested capital. It was that good of a year.
Wow.
Because the valuations were down, and so they could get in with better deal terms for the investors. And the better companies were needing to raise capital, and people lost their jobs, so they created a lot of entrepreneurship. So it's where we are now is 2 years ago, our technology would at any one moment in time would identify maybe 100 companies to invest in. And we would just start going down based upon their track score. Right now, we have maybe 15 companies. So there's just so fewer companies. And that tells me that the super forecasters are not yet predicting that we bottomed out, which is the bad news, right? The good news is that the least affected, good news if you're a seed investor or a seed stage company, is that the seed stage has not been affected as much, right?
Right.
So
it's really the later rounds, right?
It's really the later rounds that are getting hammered. So if you're a seed investor, there's still a lot of interest out there. There's still a lot of active angel investors. But as you probably talked to some of the other podcasts, problem that they're facing is a lot of them are running out of dry powder because they're not getting the exits that they used to, so their money is tied up. So anyway, so do your homework, and I don't have this yet, but we will be putting that tool that I gave you, Michael, just for your personal use, which is a research tool, so you can find the investor right for you. So that should be on our website, available for everybody in about 6 months. So if you can wait, till then. But until then, expect lower valuations. The data says the valuations will continue to drop a little bit. We've seen the major die off of valuations, especially for later stage companies, but they're likely to go down a little bit more for 2024, according to our data and according to super forecasters. But by the end of 2024, it appears that the market depends. There's so many geopolitical things and election this year, and we'll see what happens with all that stuff. But there, from a VC point of view or private equity point of view, there are more private equity firms that have announced they're going to start raising capital this year than any year in the last, I don't know how long, but there's like $1 trillion. If they can all raise what they want to raise, it's over $1 trillion of new capital. So that tells you that they believe the market will be turning and they want to be positioned to start investing again. So it's right, and we'll see.
So it's weather the storm, right? Crazy times, but
weather the storm.
I feel like honestly, it's like when you're a founder, if you complain about it, you're going to lose. You got to play by the rules of the game. The game right now is a little tough. Doesn't make it any different for anyone. Everyone's playing by the same rules, right? So you only can do what you can control, which all you can control is improving the signals that Fred gave us here today. Make sure you got some competitors. Make sure you know what they're doing. Try and emulate what it is that they're doing. I got a little thumbs up right here. That's great. Resources. Make sure that you have the human capital. You're attracting the right investors, because what that's going to do is make it so that other people want to hop on. It's going to build a FOMO frenzy. And then to add to the FOMO frenzy, make sure you're getting the right media attention, traffic to website, go viral, make other experts in your industry talk about you to show further validation. Get that third-party validation. Well, Fred, we'll wrap up.
Just named it.
Amazing. We'll wrap up here. Well, it was all that you said. So truly, I appreciate the wealth of information that you supplied for us here today. I really hope that what it does is it changes at least one founder. I'm guaranteed many more founders' direction for 2024. Is there any last words before we wrap up?
Hey, good luck, everybody. Wish you, from one founder to you, I wish you massive success in 2024 and beyond. My heart's with you. So go get them.
I love that. The founder himself, Fred, not the VC. He's a founder running a fund that's also technology. Easily the most interesting VC that I've had the reading.
Very technically. Thank you.
I'll drop his website right here that you all can go. That way you guys can all go check out Trac VC. And I'll also maybe put up your LinkedIn. That way they can try and connect with you there. That's okay.
Not to plug Business Insider, but Business Insider have just published a list of 30 super forecasters that we provided them. We won't give that out. That's confidential for us. But just to create a nice story and get us a little buzz, we've highlighted 30. So if any of those 30 are in your category, go get them. That's who you want.
Well, there you go. We'll also try and find that link after this. That way you all have access. Thank you, everyone, for hanging with us. If you've made it this far, make sure you like the video, share it with any other founder that you think would find this valuable. It's a hard time in venture capital. So we all got to work together. Startups, a fun space for everyone. We got to encourage, work together, and that's the only way we're going to make it to the other side.
There is money out there, everybody. Don't forget. You can raise money in this environment. It's just not going to be at the valuation you want. So,
absolutely. All right. Thanks again, Fred. And yeah, we'll talk soon.
Bye-bye now.
Later, everyone.